Hey, future public finance leaders! If you're a PIPFA or DAO candidate, you already know that understanding the rules of the game is literally everything. Today's explainer entirely demystifies Chapter 3 of the Financial Audit Manual, or FAM, to help you build an exact blueprint for the Department of the Auditor General of Pakistan's annual planning process. We're going to take these fairly complex regulations and turn them into a totally clear, structured framework that you can apply immediately, both in your exams and out there in the field. Let's get right into it.
So here's our roadmap for this explainer. First, the Auditor General's mandate. Second, defining the audit scope. Third, the Strategic Audit Plan. Fourth, building the Corporate Plan. And finally, integrating work and resources.
Section 1. The Auditor General's mandate. The legal foundation of audit. Let's dive right into the absolute highest authority dictating everything we do. You know, the mandate for the Department of the Auditor General of Pakistan, it's definitely not just some bureaucratic guideline. It's a massive institutional authority rooted deeply in supreme legislation to ensure the accountability of public resources. Because honestly, you really can't plan an audit without knowing exactly where your fundamental power to audit comes from in the first place. And that foundation actually rests on Sections 7 and 8 of the Auditor General's Ordinance of 2001. These sections literally require the AG to certify accounts and audit expenditures across all government levels, the Federation, provinces, and districts. This sets up our two primary objectives right out of the gate: financial certification audits and compliance with authority audits. All right, moving to Section 2, defining the audit scope, distinguishing audit types and entities. We've got the why, now let's build out our what. There's a really vital distinction here between our two main audit types. Certification audits, or financial attest audits, are absolutely mandatory under Section 7, looking at broad, high-level entities like the aggregate of all ministries. But on the flip side, for compliance with authority audits, the Auditor General has complete discretion to test specific adherence to rules. That means deciding exactly who gets scrutinized and when. Now, for those discretionary compliance audits, the Auditor General can target very specific areas. These essentially break down into three major buckets. First, organizational entities like DAOs and agencies. Second, functional entities, which examine specific processes like payroll or purchasing. And third, accounting entities, looking at specific grants or objects of expenditure. If you're prepping for your professional exams, absolutely make sure you memorize these three distinct entity types. So how do we actually determine our scope? Well, it relies heavily on a concept you're probably quite familiar with: materiality. It's basically the ultimate filter. The manual clearly defines an error as material if it's big enough to influence the decisions of the users of the financial statements. At an absolute minimum, our audit activities have to cover all entities whose operations are material. Put simply, if it's big enough to matter to the stakeholders, it definitely has to be audited. Section 3, the Strategic Audit Plan, the 4 categories of audits. With our scope defined by materiality, the Auditor General constructs a comprehensive, multi-year strategy. There's a handy 2x2 matrix that serves as your ultimate cheat sheet for the Strategic Audit Plan. Literally every audit falls into one of 4 distinct categories based on just 2 questions. Is it legally mandatory? And is it centrally led? For instance, the annual audit of the Federation, that's mandatory and centrally led. But what about discretionary compliance work done by a specific directorate? Well, that falls right into the not mandatory and not centrally led quadrant. Knowing exactly where your audit fits here completely dictates how it gets planned and budgeted. Which brings us to Section 4, building the corporate plan, from directorate to consolidation. Let's look at the actual logistics of creating the schedule that guides our day-to-day work. Logistically, this process flows strictly from the bottom up. Step 1. Individual directorates create their own detailed annual plans based on the entities they've been assigned. Step 2. They submit these plans straight to the Auditor General for approval. And finally, Step 3, once approved, all these individual pieces are consolidated into one massive master schedule, the DAGP Corporate Audit Plan. But keep in mind, a directorate's plan cannot just be some vague wish list. It has to be rigorously detailed. We're talking exact revenue and expenditure being audited, precise time schedules, and honestly, most importantly, the exact person days required matching up with specific staff assignments. You have to be crystal clear on who is doing what and exactly how long it's going to take them. But hey, here is a quick reality check for you as a future auditor. What actually happens if the math just doesn't add up?
What if the sum of your required resources, the person days you need to do all the audits you want to do, actually exceeds the actual staff you have available in your directorate? That takes us right into Section 5, integrating work and resources, maximizing efficiency and deterrence. To solve that resource puzzle, we really have to practically manage our time. Because let's face it, in the real world of public finance, resources are always strictly finite.
Well, the Financial Audit Manual gives us a very strict rule for this exact scenario. The overall workload simply cannot exceed available resources. If senior management can't magically resolve the shortfall by shifting unallocated staff over from another directorate, then discretionary audit work must be decreased. The mandatory tasks, like the financial attestation audits, are fully protected by law and have to be completed no matter what, so it's the flexible compliance work that has to be scaled back. To avoid having to slash too much of that important work, directorates are heavily encouraged to integrate their processes. What does that mean? It means running your compliance tests concurrently with your financial attestation audits. Think about it. If you wait and do compliance checks years later, you run the very real risk of discovering a massive error in year 4 that relates all the way back to year 1. That puts the DAGP in the absolute nightmare scenario of having to embarrassingly amend and reissue a financial certificate years after the fact. Integrating the work guarantees timely identification of control deficiencies. And this brings us to an incredibly cool behavioral concept detailed in the manual, the deterrence factor. Integrating audits means our auditors are physically out there on the premises way more frequently. The manual specifically highlights that simply having auditors physically present actively prevents fraud and sloppy work from happening in the first place. Your presence alone literally forces entities to maintain better controls. It's fascinating. For all you PIPFA and DAO candidates following along today, I really want you to remember that mastering Chapter 3 is not just about passing a test. It's about learning how to be the most effective, efficient, and impactful auditor possible out in the field. It's about knowing exactly how to structure your finite resources to vigorously protect public funds. So I'm going to leave you with this final thought to chew on as you continue your professional journey. Someday, when you're a director building your very own directorate plan, how will you allocate your specific person days to ensure the absolute maximum deterrence factor? Keep that question in your back pocket, and you'll be well on your way to truly mastering public finance auditing. Thanks so much for joining me on this explainer.